Ladies and gentlemen, something massive just happened in the silver market, and almost nobody is talking about it. While the world was distracted by headlines, banks, institutions, and smart money quietly moved billions behind the scenes. This isn't just another price move. This is a liquidity event powerful enough to reshape the future of silver forever. History has shown us one thing: when liquidity breaks, wealth transfers begin. And today, silver may be standing at the center of the biggest financial shift of our generation. The question is not if silver changes everything. The question is, who will be prepared before the world finally realizes what's happening? For years, the financial world operated on one powerful assumption: that liquidity would always be available. Governments believed they could print more money whenever markets became unstable. Central banks believed interest rates could control economic fear. Investors believed banks, institutions, and financial systems would continue functioning smoothly no matter how much debt accumulated across the world. But beneath the surface of this confidence, something dangerous began building quietly over decades. A pressure point formed inside the global monetary system, hidden behind stock market rallies, real estate bubbles, artificial growth, and endless money creation. Most people never noticed it because the system continued moving forward. Prices rose, markets expanded, and governments continued borrowing more money than ever before. Yet every cycle of printing, borrowing, and debt expansion weakened the foundation underneath the global economy. Liquidity is the oxygen of the financial system. Without liquidity, banks stop lending, companies struggle to operate, governments face crises, and investors panic. Liquidity creates movement. It allows assets to be bought and sold quickly. It allows institutions to meet obligations. It allows markets to function smoothly during both growth and fear. But when liquidity begins disappearing, everything changes rapidly. Fear spreads faster than confidence. Markets become unstable. Credit tightens. Financial institutions begin protecting themselves instead of supporting the broader system. History has repeatedly shown that financial collapses rarely begin with visible explosions. They begin quietly deep inside the liquidity system, where trust starts breaking apart. What makes this current situation so different is the scale of debt now trapped inside the global economy. Never before in modern history has the world carried this level of combined government debt, corporate debt, consumer debt, and central bank intervention simultaneously. Nations continue borrowing trillions while pretending the debt can be managed forever. Companies survive through cheap credit rather than real productivity. Consumers rely heavily on borrowing simply to maintain their lifestyles. Central banks continue injecting money into markets to prevent instability. On the surface, the system appears alive. Underneath, it is becoming increasingly dependent on artificial support. Every major financial crisis in history shares one common characteristic: a sudden realization that liquidity is not as strong as everyone believed. In 2008, the world discovered that banks were holding toxic assets backed by weak mortgage debt. Trust vanished almost overnight. Lending froze. Institutions stopped believing each other's balance sheets. Governments had to step in with emergency bailouts because the financial system was dangerously close to collapse. But instead of solving the deeper structural problems, central banks chose a different path. They flooded the system with more liquidity than ever before. Trillions of dollars entered markets through quantitative easing, stimulus programs, emergency lending facilities, and artificially low interest rates. For a short period, this created the illusion of recovery. Asset prices exploded upward, stocks surged, real estate climbed aggressively, technology companies reached massive valuations. But underneath that recovery, a new problem emerged. Markets became addicted to easy money. Investors stopped valuing assets based on fundamentals and started relying on central bank support. The entire financial system gradually shifted from productive growth toward liquidity dependency. Instead of allowing weak sectors to fail naturally, governments and central banks kept injecting money to delay economic pain. Then came another wave of instability: supply chain disruptions, geopolitical tensions, inflation shocks, energy crises, and rising interest rates began exposing how fragile the system had become. Inflation suddenly surged across major economies because too much money had been created too quickly. Central banks faced a terrifying dilemma. If they continued printing money, inflation could spiral out of control and destroy purchasing power. But if they aggressively raised interest rates to fight inflation, debt-heavy economies could begin collapsing under pressure. This is where the hidden liquidity crisis started accelerating behind closed doors. Higher interest rates changed everything. Governments now faced enormous borrowing costs. Corporations carrying massive debt loads suddenly struggled to refinance loans. Regional banks began experiencing pressure as bond values dropped sharply. Investors who relied on cheap borrowing started facing severe stress. Entire sectors dependent on easy liquidity began weakening. Yet the most dangerous part was not visible on television. The real danger was happening inside the plumbing of the financial system itself. Large institutions began hoarding liquidity instead of deploying it aggressively. Banks became more cautious with lending. Investors moved towards safer assets. Treasury markets experienced unusual volatility. Central banks quietly introduced emergency lending tools to prevent hidden fractures from spreading. Financial authorities repeatedly reassured the public that the system remained stable, but their actions revealed growing concern. Whenever governments or central banks start creating emergency liquidity programs, it usually means stress inside the system is far worse than public statements suggest. This is where silver enters the story in a powerful way. Throughout history, precious metals have acted as warning signals during periods of monetary instability. Gold and silver are not dependent on central bank promises. They are not liabilities issued by governments. They cannot be printed infinitely like fiat currency. When confidence in financial systems weakens, smart money often moves toward hard assets capable of preserving value outside traditional banking structures. Silver becomes especially important because it sits at the intersection of monetary fear and industrial demand simultaneously. Unlike paper assets, physical silver represents real tangible wealth. It has survived every currency collapse, banking crisis, and monetary reset throughout human history. Civilizations changed. Empires collapsed, financial systems disappeared, yet silver maintained value because it carries intrinsic demand independent of political decisions. During periods of liquidity stress, this becomes extremely important. Investors begin asking a simple but dangerous question: what happens if confidence in the financial system starts breaking down further? The hidden liquidity crisis is not simply about banks running out of money. It is about confidence eroding inside a debt-based global system that requires endless expansion to survive. Modern economies are built on constant borrowing and spending. Governments depend on debt issuance. Banks depend on lending activity. Markets depend on liquidity injections. But debt expansion cannot continue forever without consequences. At some point, the system reaches saturation. More debt creates less real growth. More money printing creates inflation pressure. More intervention creates greater instability long term. What many investors fail to understand is that liquidity crises often trigger chain reactions. One failure creates pressure somewhere else. A stressed bank affects lenders. Tightened credit impacts businesses. Business slowdowns reduce employment. Falling confidence weakens markets further. Governments intervene with more debt creation, which eventually pressures currencies and purchasing power. The cycle becomes increasingly difficult to control because every solution creates larger long-term problems. This is why silver has started attracting attention again among institutional investors, hedge funds, and long-term wealth preservation strategies. It is not merely about chasing higher prices. It is about preparing for potential structural instability inside the monetary system itself. Silver remains dramatically undervalued relative to historical monetary cycles, industrial demand growth, and expanding financial risk. Yet supply constraints are becoming increasingly serious at the same time demand continues rising globally. Industrial demand alone is reshaping the silver market. Modern technology relies heavily on silver because of its unmatched conductivity and efficiency. Solar energy systems, electric vehicles, advanced electronics, military technologies, and green energy infrastructure all require significant amounts of silver. Governments pushing aggressive energy transition policies are increasing long-term silver consumption dramatically. At the same time, mining production struggles to keep pace with future demand projections. This creates a unique situation where silver faces pressure from two powerful directions simultaneously. On one side, industrial demand continues expanding due to technological growth and global infrastructure shifts. On the other side, monetary uncertainty drives investment demand higher as investors search for protection against currency devaluation and financial instability. When both forces collide during a liquidity crisis, markets can move violently. Many people assume liquidity events only create falling prices, but history shows certain assets can experience explosive upward movements during periods of financial fear. When confidence disappears from paper systems, capital seeks safety rapidly. Precious metals often benefit because they operate outside traditional credit structures. Silver becomes even more volatile because its market is significantly smaller than gold, meaning relatively small capital inflows can create massive price swings. Another major issue hidden beneath the surface is the growing disconnect between paper silver markets and physical silver availability. Large portions of silver trading occur through paper contracts, derivatives, ETFs, and leveraged financial products, but paper claims can exceed actual physical supply dramatically. During normal conditions, this system functions because most participants settle contracts financially rather than demanding physical delivery. However, during periods of stress, physical demand can surge rapidly while available supply tightens. This creates dangerous pressure inside the market structure itself. If enough investors begin demanding physical silver simultaneously, shortages could emerge much faster than expected. Premiums on physical silver products could rise sharply. Delivery delays could increase. Market volatility could intensify. Institutional players aware of these risks often position themselves quietly before public awareness arrives. By the time mainstream attention focuses on silver, large accumulation phases may already be complete. The hidden liquidity crisis also connects directly to currency weakness worldwide. Fiat currencies depend entirely on confidence. Governments issue currency backed primarily by trust in economic stability and debt repayment capacity. But when debt levels become excessive and money printing accelerates, purchasing power gradually erodes. Inflation becomes a silent transfer of wealth away from ordinary savers toward debt-heavy systems. Over time, this damages public trust in traditional financial structures. People begin noticing their savings buy less, food prices rise, housing becomes more expensive, energy costs increase. Everyday living expenses climb faster than wages. While official inflation numbers may fluctuate, the real-world impact becomes impossible to ignore. This environment pushes more investors toward assets perceived as stores of value, including silver. What makes the current period especially dangerous is that central banks now have fewer effective tools remaining compared to previous crises. Interest rates cannot remain extremely high forever because governments themselves carry enormous debt burdens. But lowering rates too aggressively risks reigniting inflation. Printing more money may temporarily stabilize markets, but it weakens currency confidence long term. Policymakers are trapped between inflation risk and deflationary collapse pressure simultaneously. This creates enormous uncertainty across financial markets. Investors no longer trust that central banks can easily solve every problem through liquidity injections alone. Confidence in policy effectiveness has weakened. Markets have become hypersensitive to interest rate decisions, inflation data, banking stress, and geopolitical instability because everyone understands the margin for error is shrinking. Silver stands directly in the middle of this historic transition. It reflects both monetary anxiety and industrial necessity. It responds to inflation fears, currency weakness, energy transformation, and systemic instability simultaneously. That combination makes it uniquely positioned during major liquidity events. The most important aspect of the hidden liquidity crisis is that the majority of people still do not fully recognize its scale. Financial stress often builds slowly before suddenly accelerating. Early warning signs appear long before public panic arrives. Institutional repositioning happens quietly. Central banks begin preparing emergency measures behind closed doors. Large investors seek protection before mainstream headlines shift. By the time ordinary investors realize conditions have changed, asset repricing may already be underway. Throughout history, liquidity crises have reshaped entire economic systems. They destroy over-leveraged structures while transferring wealth toward those holding real assets during periods of uncertainty. Silver has repeatedly played a role during these transitions because it represents something increasingly rare in modern finance: tangible value independent of government promises. debt expansion, or synthetic financial engineering. Today, the world stands at another potential turning point. Debt levels remain extreme. Monetary confidence faces growing pressure. Global markets depend heavily on continued liquidity support. Industrial demand for silver continues rising while supply remains constrained. Central banks face impossible policy choices. Financial volatility continues spreading across multiple sectors simultaneously. The hidden liquidity crisis is no longer a distant theoretical risk discussed quietly among economists and analysts. It is becoming visible through rising instability, policy interventions, banking pressure, inflation concerns, and accelerating interest in hard assets worldwide. Silver's recent movements may not simply represent another commodity rally. They may represent an early signal that deeper forces inside the global financial system are beginning to shift in ways most people still fail to understand. For decades, the world's most powerful investors have operated differently from ordinary market participants. While retail investors chase headlines, emotional trends, and short-term excitement, institutional money moves quietly, strategically, and often long before the public understands what is happening. Smart money does not wait for television analysts to confirm opportunities. It studies risk before panic arrives. It positions capital before market sentiment changes. It focuses on preserving wealth during instability while preparing for major structural shifts inside the global economy. Today, one of the clearest signals emerging from financial markets is the growing movement of smart money towards silver. This shift is not happening because of temporary hype or internet speculation. It is happening because experienced investors recognize that the current global financial environment carries risks unlike anything seen in modern history. Debt levels are exploding worldwide. Currency purchasing power continues weakening. Geopolitical tensions are rising. Banking systems face growing pressure from higher interest rates and liquidity stress. Governments continue spending at historic levels while central banks struggle to maintain control over inflation and economic stability simultaneously. In this environment, smart money is searching for assets capable of surviving uncertainty, protecting purchasing power, and benefiting from future systemic changes. Silver occupies a unique position unlike almost any other asset in the world. It is both a precious metal and a critical industrial resource. This dual role makes it extremely attractive during periods of economic transition because it can benefit from multiple powerful trends at the same time. On one side, silver acts as a historical store of value during monetary instability. On the other side, it plays a vital role in modern industrial production, technological advancement, and global energy transformation. Smart money understands this combination creates an opportunity that most ordinary investors still underestimate. One of the main reasons institutional investors are paying close attention to silver is the growing fear surrounding fiat currencies. Modern currencies are no longer backed by physical assets like gold or silver. Instead, they rely entirely on confidence in governments, central banks, and economic systems. For many years, this structure appeared stable because inflation remained relatively controlled and financial markets continued expanding. But over time, governments around the world accumulated massive amounts of debt while central banks injected unprecedented liquidity into economies. Trillions of dollars were created digitally to stabilize markets, stimulate growth, and prevent recessions. This massive expansion of money supply fundamentally changed the financial landscape. When governments create enormous amounts of currency without corresponding increases in real productivity, purchasing power eventually weakens. Inflation becomes unavoidable. The cost of living rises, savings lose value gradually. Investors begin questioning how long currencies can maintain strength under such extreme debt burdens and continuous monetary expansion. Smart money understands that currencies can be devalued far more easily than hard assets. Silver becomes important in this environment because it cannot be created artificially by governments or central banks. It must be mined, refined, and physically produced. Its supply is naturally limited by geology, mining capacity, and industrial availability. Unlike paper currencies, silver carries intrinsic value recognized across civilizations for thousands of years. During periods of monetary uncertainty, institutional investors often move toward assets that exist outside the traditional financial system because they provide protection against currency erosion and systemic instability. Another reason smart money is moving into silver involves growing distrust in long-term government financial management. Many major economies now operate with debt levels that would have been considered impossible only a few decades ago. Governments continue borrowing trillions simply to maintain spending obligations. Interest payments on national debt are increasing rapidly as rates rise globally. This creates enormous pressure on public finances. Smart money recognizes that governments facing unsustainable debt often rely on inflation, currency devaluation, or aggressive monetary policy to reduce the real burden of liabilities over time. In simple terms, inflation quietly transfers wealth away from savers and toward debt-heavy systems. Currency loses purchasing power while real assets tend to appreciate. Smart money positions itself ahead of these cycles because preserving wealth becomes more important than chasing speculative returns during periods of monetary instability. Silver's historical role as a hedge against inflation makes it increasingly attractive as confidence in fiat systems weakens. At the same time, industrial demand for silver is entering one of the strongest growth phases in modern history. This is another critical factor driving institutional interest. Unlike gold, which is used primarily for investment and jewelry, silver has essential industrial applications across multiple rapidly expanding sectors. It is one of the most conductive metals on Earth, making it crucial for advanced electronics, renewable energy systems, electric vehicles, medical technologies, aerospace equipment, telecommunications, and military applications. The global transition toward clean energy is dramatically increasing silver demand. Solar panels require significant amounts of silver for conductivity and energy efficiency. Governments worldwide are investing heavily in renewable infrastructure as part of long-term climate and energy strategies. Electric vehicles also depend on silver because of their advanced electrical systems and battery technologies. As production of EVs accelerates globally, industrial silver consumption continues rising steadily. Smart money understands that industrial demand creates a long-term structural foundation underneath the silver market. Even during periods of economic slowdown, technological advancement and infrastructure transformation continue driving silver consumption higher. This industrial demand is happening simultaneously with rising investment demand caused by financial uncertainty. When both investment demand and industrial demand increase together while supply remains constrained, markets can experience explosive repricing. Supply constraints represent another major reason institutional investors are accumulating silver. Mining production has struggled to keep pace with projected future demand growth. Many silver mines face declining ore grades, rising operational costs, environmental regulations, and geopolitical challenges. Unlike fiat currency, silver cannot simply be produced instantly to meet rising demand. Expanding mining operations requires years of investment, infrastructure development, permitting, and production scaling. Additionally, a large portion of global silver production comes as a byproduct of mining other metals such as copper, lead, and zinc. This means silver supply is partly dependent on the economics of other mining industries rather than silver demand alone. Smart money recognizes that supply shortages can emerge much faster than most investors expect if demand accelerates sharply during periods of financial stress or industrial expansion. One of the most important aspects institutional investors are monitoring closely is the disconnect between paper silver markets and physical silver availability. Modern commodity markets rely heavily on paper contracts, futures trading, ETFs, and derivatives. These financial instruments allow enormous amounts of silver exposure to exist digitally without requiring immediate physical delivery. Under normal conditions, this system functions smoothly because most participants settle contracts financially rather than demanding actual silver. However, smart money understands the danger hidden inside this structure. If confidence in financial systems weakens significantly or physical demand surges rapidly, the gap between paper claims and available physical silver could become extremely important. A relatively small percentage of investors demanding physical delivery simultaneously could create severe pressure on inventories and market stability. Institutional investors aware of these risks often prefer holding physical precious metals or secure allocated storage rather than relying entirely on paper instruments. Another factor driving smart money into silver is growing geopolitical uncertainty. The world is entering a period of increasing fragmentation, economic competition, and strategic tension between major powers. Trade wars, sanctions, supply chain disruptions, regional conflicts, and energy security concerns are reshaping global markets. These geopolitical pressures